my name is Dana Golden. So we're continuing today's discussion of fundamentals derivatives with a look at commodity portfolios and their valuation. So before we discuss how to price commodities, how to price futures, now we're looking at commodity portfolios, which is a collection of investments in different commodity assets. Some of them might be futures, some of them might be physical commodities, like direct ownership of gold and oil, and then some of them might be financial instruments like futures, options, swaps, and ETFs. And your goal normally should be to diversify and create exposure across multiple commodities to reduce risk. So how do you think about valuing the commodities? Obviously, when you have a physical commodity, you should look at the spot price, and you should also think about the relationship between the spot price and the future price. Are you going to sell this on the futures market? Are you going to sell this on the spot market? When do you intend to sell it? And that should give you a sense of, and also, do you enjoy the optionality? Do you value the fact price can go up or down? Do you want to hedge against that because that's bad for you? So that should all go into the valuation. And then, of course, you perform risk adjustments. There's commodity beta, which is the sensitivity of your portfolio to different commodity movements, how much risk there is. And there's volatility, how much prices fluctuate over time. And then what you want to do to value the entire portfolio is you sum up for each different time period in each different object in your portfolio the expected cash flows divided by the interest rates. This is the discounted cash flow analysis we talked about earlier in the class. So what you want to do is you want to use metrics like Sharpe ratio, and value at risk to balance risk and return. My grandfather is a really great guy. I was originally named after him. So he's a really phenomenal guy. He's a gold bug, and he has a lot of investments in small cap healthcare. And he says the investments have done well. And even if the investments have done well, small cap healthcare is a really volatile, really risky sector. So those investments have to be doing really, really well to do well. So this is just to say, when you're thinking about these portfolio success, you don't just need to think about like whether or not your portfolio went up, but you need to think about how risky it was and whether or not the portfolio went up enough to justify the amount of risk you can take. Because the market correlates risk and return, and you don't get to see the other scenario where the portfolio took a nosedive, and if you hold stocks long enough to take enough risk, you'll see both scenarios. So you want to protect against downside risk. You want to understand whether or not you're getting enough returns to justify the risk you're taking. So real optionality refers to the flexibility embedded in real assets or investment decisions. And this is the idea that you want the possibility to expand or delay a project. You want the ability to change production levels of the commodity. You want the ability to switch between energy sources based on cost and availability. Generally, people pay to have options. People like certainty in cash flows, but they like to be able to change around their cost structure. They like to have options. They like the real optionality in their portfolio where they can change different features. So value is derived from the uncertainty in the underlying variables. If you have all this uncertainty in prices and demand, you like to have a way to mitigate that uncertainty. You would like to use futures to prevent price movement against you, but you'd also like to have the option to mitigate extenuating circumstances and possible risk. So we talked about Black-Scholes and binomial trees, BAPM, last time. So this is often how you'd evaluate how worthwhile is real optionality either in the financial or physical space. And the importance of commodities, real optionality influences how you invest in different infrastructure projects. You're not going to want to invest in an infrastructure project rapidly if you know it's going to be there for a long time. You don't have many choices. Having the ability to close the door and walk back through it is very different from closing the door and it's just closed. You want real optionality and you're willing to pay for it. This is why options have a cost in financial markets. And then this provides a competitive advantage in volatile markets. And then, of course, you have commodity beta, which measures the sensitivity of a commodity's price to the broader market movements or an index of commodities. So this is beta of the commodity is the covariance of the commodity in the market divided by the variance of the market. Very similar, if any of you know equities or taking corporate finance, to beta in the stock market, and it indicates the systematic risk of a commodity. Commodities with a high beta are more volatile relative to the market, and you need to be accounting for the risk you're taking by understanding are you getting enough returns to justify that risk? And then low beta commodities are less correlated. We know from traditional finance that actually, even if you have risky assets, even if your commodity is very risky, you can create a portfolio that's less risky by buying a certain amount of that risky asset and then a certain amount of treasury bonds. So you can have the exposure, and this is something we know from the capital asset pricing model alongside other financial discussions, that you can create a certain amount of risk and returns by buying a basket of commodities and basket of assets to add to your basket of risky assets. So you can get exposure to the risk, and you can add other assets that have various correlations to allow you to change how risky your portfolio is based on the risk and return you want. And so commodity beta is used to assess the risk in commodity-based portfolios, and it helps in understanding how much of commodities return is driven by market-wide factors and how you should be hedging against this risk. And then commodity alpha measures the excess return of a commodity over expected return based on commodity risk. So commodity alpha is the return of a commodity minus the beta of a commodity times the return of the market, how risky it is, how much return the market's getting. Are you outperforming the market, and are you outperforming the market by enough to justify the risk you're taking? Remember the story I just told you just now where someone was taking a lot of risk and they were only reporting that they had great returns. Well, do the returns justify your risk tolerance, the fact that you might lose some of that money? So this represents the performance due to factors unique to the commodity. It captures idiosyncratic factors like supply disruptions, technological changes, or geopolitical events. As a critical measure for active management in commodity markets, investors are seeking this. This is what you want. You want to outperform the market. No one wants to underperform the market. Beta reflects systematic risks, and this is risk that you just have inherently by being in the market or by being in this commodity. Well, alpha is whether or not you're beating the market, how good you are at the trading. And then real optionality versus commodity beta and commodity alpha. Real optionality focuses on the flexibility to adapt to market changes. So long-term strategic value in commodities like storage, production, flexibility. Commodity beta measures systematic risk and market sensitivity, and commodity alpha measures unique excess returns. Really, the commodity alpha should be zero. You're not beating the market in most cases. But the reason why it might not be zero is because you might know a lot about the market. You might know the commodity. You might be a better trader. And if you spend a lot of time, you might somehow beat the market, though that's very unlikely because of the efficient markets hypothesis. Thank you, and I hope you have a great day.